Hi, I am Akshat Malhotra. This isn't just a standalone video, but a part of an entire course called The Fundamentals of Personal Finance. In Module 1 and 2, we covered the key concepts and went straight into creating an effective budgeting plan. Now, in Module 3, we deep dive into the various financial assets where you can park your money in. Oh, and don't forget the free Excel calculators that we've created just for you. Let's begin with fixed income products. And as the name suggests, fixed income means the day we invest our money, we know how much are we going to get in return. And the most common option, and I also believe the most favorite option of us Indians, is the fixed deposit or the recurring deposit. What is a fixed deposit? What is a recurring deposit? Let's understand that. So fixed deposit is an instrument in which the bank says, the bank or the NBFC or any of the organization that has taken out that fixed deposit says that you as a customer, you come, you give me your money. I will use the money that you give me for, my operations, paying out loans, so on and so forth. But in return, I will pay you some fixed percentage every year. So that means, for example, let's say you invested 50,000 rupees of money. You gave 50,000 rupees to the bank, and the bank said that I guarantee you that after 1 year, when you come back, you'll get 5% return on this particular amount. Just taking for an example, 5%, right? So after 1 year from today you've given the bank 50,000 rupees. After 1 year from today, you will get 50,000 plus 5% of 50,000, 2,500. So you will get 52,500 rupees back. That's as simple as what a fixed deposit is. On the other hand, in a recurring deposit, let's say we do not have 50,000 rupees at one go. Rather, we have about 5,000, 4,000 rupees every month. So we will deposit 4,000, or we'll give the bank 4,000 rupees a month for the next 12 months, roughly 48,000 rupees. And then on top of that, we will get a 5% return back from the bank. So nothing, fixed deposit, you pay the amount at once to the bank. Recurring deposit, you give an equal weightage of amount every month to the bank. That's the only difference between a fixed and a recurring deposit. But the mechanism, the function is the same. Both these instruments give you a fixed return, and the bank promises that fixed return on the day when you choose to open up that fixed deposit or a recurring deposit. Clear? As simple as that. Now let's learn about few of the pros and the cons that these instruments have, that this particular instrument has. Number one advantage, it is the safest form of investment option available. The bank guarantees you, so there is no loss of principal. In fact, as per the RBI guidelines, up to 5 lakh rupees is insured. So which means even if something happens to that particular bank, it goes bankrupt, it's not in operations, up to 5 lakh rupees of fixed deposits are insured, you will get that money back. So yes, it is definitely the safest form of investment. Number two, it gives you a fixed rate of return. So no surprises on the day when you're investing, you know how much you're going to get in return. And number three, you have a flexibility to choose from, 7 days to 10 years, as much as you want to keep your money invested for. So you have that flexibility. Let's look at the cons now. Number one, it's tax inefficient, which means whatever interest you earn from this particular fixed deposit, you'll have to pay taxes on that. Yes, there is a particular 5-year fixed deposit, which means that if today you open up a fixed deposit for 5 years, you take out your money after 5 years, on that particular fixed deposit, you don't have to pay any taxes. But that's a separate category of fixed deposits. But in general, for 7 days, 14 days, 1 year, 2 years, 3 years, whatever tax you earn, whatever interest you earn, you have to pay taxes on that. Now, secondly, it's illiquid in nature. And what do I mean when I say illiquid? Is, let's say I've opened up a fixed deposit today for 1 year. In a period of 1 year, I am not supposed to take out my money, or rather that money is not available for me to spend. So I will have to go forward and break the fixed deposit and pay some charges and penalties. And how does that work? Let me help you understand that. So let's say today you opened up a fixed deposit of 1 lakh rupees for 1 year. The bank guaranteed you 5% return. So 1 year from today, you're going to get 1,05,000 rupees back, right? But something happened and just 6 months from now, you need that money. 6 months from now, you are in a situation where you need your fixed deposit. So in that case, you go to the bank and you ask them to break your fixed deposit. The bank will definitely do that, but they will charge you something. So what would happen is the bank will go back to the day when you opened up your fixed deposit, and on that they'll see what was the prevailing 6-month interest, because you've broken it after 6 months, right? You're breaking it after 6 months. So what was the prevailing interest rate on the day when you opened the fixed deposit for a 6-month FD? Let's say that was not 5%, let's say that was 4%. So in that case, the bank will convert your fixed deposit from a 1-year fixed deposit to a 6-month fixed deposit. So which means originally where you were getting 5% return, you will now get a guaranteed 4% return. And on top of that, they may charge you 0.5 to 1% penalty depending upon bank to bank, right? So which means that it is illiquid in nature. You definitely can break it in terms of emergency, but you'll have to pay a small charge for that. And yes, that is all in all what fixed deposits and recurring deposits are about. Next up is the Public Provident Fund, a very commonly heard scheme. And yes, it comes with a sovereign guarantee, which means it's backed by the Government of India. And just like in the case of a fixed deposit, the bank says that you give me money and we'll use it for our operations and then we'll pay you a return back. In Public Provident Fund, the government does the same. The government says that you give me your money and we'll take care of that money. We'll use it for whatever operations, whatever expenses we need to. And in return, we'll guarantee you a fixed interest rate. It's generally a little higher than the other fixed interest rates available to us. As of the second quarter of financial year 21-22, it's logged at 7.1%. So how does a PPF scheme really work? When we go and open up a PPF scheme, we've got to open it up for a 15-year period. So it comes with a 15-year lock-in period, which means that today, when I start depositing my money, I'll have to keep depositing for the next 15 years. I can deposit a minimum of 500 and a maximum of 1.5 lakhs in a financial year. And 15 years later, I'm going to get the money back along with the interest that I've earned. And the great part about this is whatever interest I'd earn will be completely tax-free. I do not have to pay a single tax on whatever money I earn after 15 years. In addition to that, the 1.5 lakh rupees that I deposit up to a maximum 1.5 lakh rupees is also available for tax deduction, is also eligible for tax deduction would be the right word, under section 80C. Cool. So yes, the pros are sovereign guarantee, tax efficient, 15 years. So we know the compounding will happen 7.1% as of today. The compounding will keep happening, and after 15 years, we'll get a huge lump sum amount. And along with this, there are two more good features you could say. Number one, after 3 years of depositing your money in a PPF, you can take a loan against the money that is there in your PPF account. And also after 7 years of you opening the PPF account, you're eligible for some partial withdrawal. Okay, so you can take out some money. The rules can be found out in the link. But on the other hand, the cons are that it is highly illiquid. And when I say illiquid, because 15 years, you cannot even break the PPF, you cannot do anything. 15 years you have to stay invested. You have to deposit a minimum of 500 every year so that your PPF continues to remain active. And so it has a lock-in period of 15 years, which means the liquidity is not as high as you would expect it to be, right? Also, it doesn't mean that you have to take out your money after 15 years. Let's say you want to invest, you want to remain invested for a period of 30 years, 35 years. So after 15 years, once you've crossed the lock-in period, you definitely can withdraw it. But if you don't want to withdraw, you can continue staying invested. You will get all the benefits of it, and you can renew it for a period of 5 years and a period of 5 years of interval. So that's all in all about the Public Provident Fund. Then comes the National Savings Certificate. Once again, a Government of India backed scheme. In this scheme, it works very similar to fixed deposit, recurring deposit, PPF. You deposit your money for a period of 5 years. That's the minimum. And whatever interest rate is prevalent at the time when you're investing your money, you would get that at the end of 5 years. As of the third quarter of FY 21-22, this is fixed at 6.8% per annum. Now, once again, it comes with a sovereign guarantee. So, we can be relaxed. The loss of principal is not going to be there. The contributions are eligible for tax deduction under Section 80C once again. And the only con is it is illiquid because of the 5-year lock-in period that it has. A minimum of 1,000 and a maximum of no limit really is what you can invest into a National Savings Certificate. If you are the parent of a girl child, this scheme could be very useful to you. Called the Sukanya Samriddhi Yojana, it was launched under the Beti Bachao Beti Padhao campaign to promote child education, girl child education. Now this scheme can be opened up till your daughter attains the age of 10 years. So which means you'll have to open it before she turns 10. And it comes with a maturity period of 21 years from the date when you open up that scheme. However, it does allow you partial withdrawals after the girl turns 18 years of age for a higher education, for a marriage, so on and so forth. So up to 50% amount can be withdrawn once the girl turns 18 years of age. As of the third quarter of financial year 21-22, it's offering a 7.6% fixed rate of return. And then this is quarterly reviewed and changed as per the government regulations. Now, definitely comes with a sovereign guarantee. So, you have your principal is safe. You don't have to worry about that. A minimum of 250 and a maximum of 1.5 lakh per year can be deposited into this scheme. Deposits have to be made till the completion of 15 years from the date of opening the account. And after that, you may or may not make the deposit, but the account will continue to earn the interest till maturity. So those are the high-level features, but yes, it definitely also acts as an illiquid asset because you may not be able to withdraw all of the money when you need it. That is Sukanya Samriddhi Yojana, and it can be opened up for at least 2 girl childs. For the third girl child, there are few exemptions that you'll have to read about. And now next up is bonds, government bonds or corporate bonds. And both corporate bonds come from private as well as public companies. Now, let's take an example here. Let's say I, Akshat, from Pennywise needs some money. One is we go to the bank to get the loans. Or another way is I tell that Pennywise is taking out a bond, and if you believe in our company, let's say we want 50,000 rupees, and if you believe in our company, if you feel this company is going to grow, you give us your 50,000, but I give you a guarantee on a bond that I will give you 7% return. The company will give you 7% guaranteed return in a period of 1 year, 2 years, so on and so forth. So we take out a bond from the company that people can invest their money in. Now, if they feel that the company would do well, the company has strong fundamentals, They can buy that bond and get a fixed rate of return. What are the pros here? Again, it's a predictable stream of income, which means you know how much you will earn post the completion of the maturity period. However, poor liquidity because it's a 1 year, 2 year, 5 year bond. And secondly, what if the company doesn't perform well? What if the company goes bankrupt? So there is a risk of losing your capital as well. So although it does qualify for a fixed income instrument because you are guaranteed a fixed income instrument, but in case the company defaults, just in the case of a fixed deposit, if a bank defaults, you at least have a 5 lakh insurance. Here you do not have any insurance. If the company defaults, you may lose your money. So both public companies, private companies, and even the government companies take out their bonds. Government bonds are relatively much safer as compared to the bonds by the private and public companies. But at the same time, since they are very safe, the rate of interest is pretty low. So this is another way where you can invest, another option for you to select for your fixed income asset class. Now, there are a number of websites on which you can check the available bonds. We will share a few of the resources with you as well. And these bonds also get a rating from various agencies. So the bond with a AAA rating is supposedly the best bond. It usually, since it's best, it usually would have a higher lock-in period and a less rate of interest. But yes, if you feel that that is something that you'd like to go and park your money in, it could be a good option. And now for all these options, all the fixed income instruments that we studied about, how do you go and get started? You could visit the nearest bank branch, or you could visit a post office, and all of these schemes are going to be available there. For buying the bonds, there are a number of websites, aggregator websites. We will definitely share a few of the resources. Along with that, you could also go and look at the respective websites of various companies. You could get started in less than half an hour. So what are you waiting for? Go ahead and start researching more about this. If you have any questions, please add them in the comments below and I will make sure we answer them. Do like, share and subscribe to this channel.